Hey, what's going on, savers and investors? I hope you're all having a great day as always. If you're new to the channel, then welcome. My name's Griffin, and in today's video, we're going to be speaking about the state of the overall economy as well as the stock market, as it's been losing a little bit of steam while creeping back up to the market highs of February. This happens to also be right before and during the busiest reporting period for second quarter earnings of most large publicly traded companies such as FANG stocks and other large multinational corporations that we recognize and purchase from. Now, as a financial YouTuber who spends way too much time reading through financial news articles, watching YouTube videos, and pretty much just always trying to get a grasp of what's going on in the financial markets, I've been seeing somewhat of some patterns over the past little while that I thought would be worth speaking about in a shorter stock market news style video. So in today's video, we're really going to be focusing on some specific data points as well as relevant metrics and really just trying to get an overall objective view of what's going on in the overall economy as well as the stock market, with a focus on what might be around the corner for the stock market in the coming months. The goal of this video is really just to give you a more broad and macroeconomic view of what's going on in the market, which honestly is just as important as some of my more specific company analysis videos in order to make you a more critical and well-rounded investor. So if you enjoy this video at any point in time, you know what to do. Drop a like on the video and make the like button turn blue. It really helps my channel grow with the YouTube algorithm. Alright, so with that said, we've already spoken about the idea of a potential stock market correction in previous content that I've released on the channel, with my theories really revolving around stimulus packages propping up the economy, as well as gross domestic product slowing down, the medical issue as a whole, and unemployment rates. Well, even though the arguments brought to the table were very sound in my opinion and made logical sense both back then when I released those videos and are still relevant to this day, the fact of the matter is the stock market has not corrected itself and is still following that V-shaped recovery pattern to this day. But has it really, and is it slowing down? So this begs the question, do macroeconomic events even matter anymore in relation to how the stock market behaves and trends over time, since right now we're seeing the two really not following the same sort of pattern, and that's really what I wanted to address once again in today's video. FYI, the information contained in the first half of this video is based strictly on facts, and then the second part of this video is reserved for my thoughts and opinions on what might be going on in the stock market and could potentially happen over the coming months. Okay, so I think it would be fitting to first speak about what caused this fiasco in the first place, which happened to be the whole Roni situation, to see, well, hey, how has this progressed since the first shutdowns, and are things trending in a positive manner in both Canada and the United States? The whole reason governmental bodies shut down the country was to try and stop the medical issue in its tracks, but obviously a byproduct of doing so was a massive economic slowdown across North America, especially for industries such as travel, airlines, restaurants, and hotels. For the most part in Canada, wearing a mask in public is now mandatory, and as a country, we're doing pretty well from a damage control perspective if we look at a chart of the number of daily new cases of the Roni situation. Now, even though this is fantastic from a public health standpoint, the whole goal of my channel is to speak about financial topics, and the reality is that the Canadian stock market is only a fraction of the size and influence of the American stock market, and for this reason, the Canadian economy as a whole is also very dependent on the American economy because it's our largest trade partner. If we look at the same graph, however, for the United States, it's very apparent that things are much different down south of the border. In fact, in my previous video speaking about a potential stock market crash that could have been on the horizon, I had made mention of the BLM rallies where thousands of individuals were all jam-packed together in relatively tight public spaces, and I had questioned whether or not, if it was as severe as we thought, there would theoretically be a surge in new medical cases. Well, I released that video on June 10th, which was about 5 weeks ago, and since then, if we look at this new case graph, this actually perfectly lines up and strengthens my prediction and theory about this. This data about a surge in new medical cases brings me to my next point, which is that many states are rolling back their reopening initiatives, forcing companies to temporarily close their doors again, meaning more financial strain ahead for many of these bars, restaurants, and small businesses across America. In fact, if we look at this data compiled from Yelp, well, as of July 10th, over 16,000 restaurants have permanently closed their doors, which had previously been open on March 1st. This represents 60% of all restaurants that were open only 3 months prior. Think of this data for a second, it is really striking. 60% of all the restaurants that were open only 3 months back are now permanently closed for good. On the retail side, we're looking at 48% of shopping locations permanently closing their doors. The same sort of ratios also manifest themselves in the spa, bars, and fitness industry industries also, meaning roughly 50% of all these small to medium businesses marked open on March 1st have now permanently closed their doors. Another interesting point to mention about the economy is comparing private companies to publicly traded companies. So in the United States, there happens to only be less than 1% of all companies in the country that trade publicly on stock exchanges. So think about this for a second. While thousands of businesses across the United States are shutting their doors because they simply cannot sustain business operations due to these really difficult times, the public markets are going the complete opposite direction in a positive trend. This is definitely questionable market behavior and doesn't necessarily make logical sense. And companies, both private and public, have taken on significantly more debt in order to cover their expenses and continuing business operations. In fact, most of the companies that I've done a specific company analysis on, including Air Canada, RioCan, and practically every other company, have taken on significantly more debt levels in order to cover the bleeding from their truncated revenues over the past couple of months. This essentially means that the liability column has gone up for most of these companies, while the short-term assets and even total assets for that matter have been dug into. And what does this mean for most companies in the larger picture? Well, other than the fact that in the short term, most companies are going to be seeing significantly truncated revenues as well as more costs associated with running their operations due to interest expenses on the debt that they've taken on, this could very well mean that for many companies, it could take multiple years in order to fully recover back to those 2019 levels where business was running optimally. And actually, if you remember from my Air Canada Q1 analysis video where we dug into the balance sheet and income statement of the company, the CEO had mentioned back in that statement that it would take probably up to 3 years in order to recover back to the 2019 levels. All this to say that one of the main factors that I brought up in previous videos speaking about a potential stock market crash was related to the unemployment rates in both Canada and the United States. Now, in response to this really high unemployment rate, both governments have put in place some stimulus programs in order to try and reinvest back into the economy, pouring money into the economy and trying to prop up the stock market, which as of right now has seemed to work. Well, in the last week, the American unemployment claims have been on the rise again for the first time in 4 months, translating over into another 1.4 million Americans filing for first-time unemployment benefits. This graph clearly showcases this phenomenon and actually happens to be right as the last stimulus check is set to be shipped out on July 31st. This represents around 25 million Americans that are receiving stimulus compensation that is set to end right when there is a resurgence in new cases and businesses are closing down again in some states. Simply put, the issue here is a rising unemployment rate without a proper stimulus plan in place right now. So is the US government going to continue pumping the economy in order to prop up the stock market? This is really still the unknown. However, let's remember that my thesis from the previous video still has not changed in relation to the stock market. The only reason the stock market has recovered in a V-shaped pattern as of right now is due to the government's financially supporting the economy. That's pretty much it. Nothing else would suggest that the economy is actually recovering at a parallel pace and trend to the stock market's recovering trend. Okay, so as an investor myself, and most likely yourself if you're watching this video, we want to know how this all relates back to the stock market and the future of what might be ahead for the stock market in the coming weeks and months. This definitely isn't news to anyone, but since the March lows when the Dow Jones Industrial plummeted more than 38%, we have now seen a recovery in the 42% range. So is this justified from a macroeconomic standpoint? Well, for one thing, we're seeing investors becoming very bullish on anything that has to do with tech stocks and internet-based companies that don't need physical distribution models in order to make sales, with the idea here that we're moving to an era where everything's going to be purchased online. Nonetheless, we're currently seeing extremely high price to earnings ratio, and this is at a moment in time when the stock market has not yet felt the effects of the underlying economy that are probably going to be rippling through for a couple months, if not years to come. My personal gut feeling is that it's somewhat inevitable that most all of these companies are going to be reporting revenue figures for Q2 that are below expectations. But at the end of the day, what were investors expecting with Q2, let's remember, being a 3-month period spanning from April all the way to June. So this is during the peak shutdown period of most companies across North America. The way I see it is that current market prices are are pricing in the expectation of earnings not being nearly as bad as what they most likely will turn out to be, but that's just my opinion. And this is translated over into stock prices that have been creeping higher and higher and higher over the past couple of weeks to price points where now most tech stocks are eclipsing their valuations as of February even. All this to say that if a large chunk of investors do end up deciding to cash in their profit at these extremely high valuations, this would have the impact on a wide scale level of shooting up the supply in the market because more investors are selling their shares and taking profits than purchasing shares of companies, and this has the effect of driving down market prices, which if this does end up happening in correlation with everything else that we just spoke about, this could potentially have a detrimental impact on the stock market as a whole. Finally, I called it in my most recent video speaking about a potential stock market crash that in the information age, meaning right now, where everyone has access to trading information in milliseconds and everyone has access to a commission-free mobile stock brokerage, that I believe that the stock market would rebound much quicker than in previous recessions such as 2000 and 2008, for example. This prediction once again seems to be relatively spot on actually, and could also be a contributing factor in the opposite market trend. Alright, so with everything that we just covered, what do I personally think of a potential stock market correction on the horizon in relation to everything we just spoke about from a macroeconomic standpoint? And first and foremost, I do want to mention that everything we're about to speak about is really just my own thoughts and opinions, and at the end of the day, no one can 100% accurately predict any of this. In my previous video about the topic, I said that I wouldn't be surprised if there would be a potential market correction in the near future, and hey, it hasn't happened as of yet. Ultimately though, I really think that this depends on a couple of key main factors, the first one being the Q2 earnings that for the most part are being released this week, and this is in regards to whether or not earnings will be above or below expectations in relation to the fact that right now investors are pricing in positive earning expectations into stock market valuations. Q2 earnings will for sure have a short-term impact on the market trends, but on a larger scale, Q3 and Q4 earnings are going to be much more significant in revealing the true financial recovery period of most companies. The second main factor is whether or not the government is going to extend financial aid for unemployed individuals as well as small to medium-sized businesses. This factor is huge since we're seeing an uptick in unemployment levels once again, but ultimately, I mean, this has already been quite prevalent already, and the government can only print so much money, at least sort of. At this point, it's been made very clear that the US government will do everything and anything in their power to prevent the economy from sliding back into recession mode, even if that means printing more money if they have to, which inevitably would lead to insane depreciation of the dollar. And other than printing more money, governments typically turn to lowering the underlying interest rate of the economy in order to stimulate the economy by allowing people as well as companies to borrow funds at a lower rate. However, this is currently translated into rock bottom interest rates, which can't really go any lower. With that in mind, if you've recently refinanced your home or are in the market for purchasing a home right now and taking advantage of these rock bottom interest rates, make sure to smash the like button, and I might just make a video speaking about this topic. So this all really boils down to my personal thoughts on what I think will happen in the coming months with the stock market. So first of all, I think that with Q2 earnings being released this week, as well as Q3 and Q4 earnings, we're going to see the stock market slowing down the upwards trend into a flattening curve and maybe even possibly a slight downward decline. So from that standpoint, yes, my theory has changed since previous content, where I don't think we're going to be seeing anymore a steep stock market correction, because ultimately I really don't see the government letting this happen once again, even if that means continuing pumping the economy with more stimulus dollars. Instead, I think we're going to be seeing a flattening curve for quite a while and then a more gradual recovery over the coming years. If you've been following my channel for a while, then you would most likely know that I'm the type of investor who's looking to be investing in companies that I believe are solid financially for the long term and have the potential of growing my portfolio and wealth over the period of time where the company is going to be expanding and growing their earnings. For this reason, due to the fact that the market is valued extremely high right now, it is definitely harder than ever to find deals that I personally feel comfortable with for the long term, and so for this reason, I do have a large portion of my portfolio in cash, and I'm picking up positions here and there when I see value to be had. But again, let me reiterate that none of this is 100% predictable, obviously, in that if you're a true investor for the long term looking to grow your wealth over time and not a speculative gambler, then I would suggest that you continue investing in the same manner that I've been preaching over the past 2 and 3 years of investing in solid companies and ETFs over the long term, playing the course and riding through ups and downs. Do you personally believe that we're going to be seeing another correction by the end of the year, or do you think the government's going to continue pumping the economy full of stimulus checks and propping up the stock market? I'd love to know down in the comments what your thoughts are. So if you enjoyed this video, please make sure to give it a thumbs up, subscribe to the channel, and hit the bell button so that you're notified whenever I release a new piece of content related to personal finance, stock market investing, or real estate. On that note, if you want to learn more about stock market investing, check out one of the two videos I'm overlaying right here. And on that note, I'll see you in the next one.